Hello, welcome back. In this video, I wanted to walk through some things to think about before you even put money into your brokerage account to invest. Most people might just jump straight to asking, what stock should I buy? But I think a better approach is to begin with the end in mind and work your way back from there. Okay. So the first thing to ask is, what is your goal? Why are you investing? Is this just for fun? Are you just trying to get a better rate of return than having your money sit in a bank account? Or is this your main nest egg that you're counting on long term and you're working toward retiring? If you're working toward retiring, what age do you want to retire at? Most people just default to 65 years old because that's kind of the standard answer. But maybe you want to try and retire earlier than that, and that might be possible. But how you invest has to line up with that goal. And then if you're working toward retiring as well, what type of account you should set up is really important and is a big thing to think about as you're starting out. So with tax advantaged accounts like 401k or IRA, there are big benefits, but there are also rules. In most cases, you can't access that money or can't access all of that money until you're 59 and a half without facing penalties, right? So if your goal is to retire earlier than that, you may want to use a taxable brokerage account. Even though it's not as tax advantaged, you're trading tax benefits for the flexibility. So that decision can shape your entire strategy. It also influences what kind of investments you should buy. Do you want to just buy growth focused funds and let them compound for a really long time? Or do you want to buy dividend paying or income producing investments that could help generate cash flow and maybe support an earlier retirement? Or do you want to do a mixture or do growth for a while and then switch it over to dividends and income producing investments, right? And there's no single right answer, but your investments should match how and when you plan to use the money and what your goals are, right? So the next thing is risk tolerance. So one thing that I find helpful when thinking about risk tolerance is going back and looking at historical data to see how your portfolio might have behaved in the past. So a really useful tool is Portfolio Visualizer. It's free. I'll put a link to it in the description somewhere. But you can put your portfolio in there and you can see all the data, how it performed in the past. Like how much did it drop during a really bad year, like as a percentage, and then say you had like $100,000 in there, or you can say whatever amount of money you want it to use, and say in a really bad year you lost $10,000, or you lost $20,000, or $50,000 or more, right? How really think about what would that do to you? How would that make you feel, right? And how long also did it take for your portfolio to recover? Because it's one thing to say you're comfortable with risk, and then it's another thing to watch your account drop 30 or 40% and stay invested. So your strategy should match the level of risk you can realistically live with, especially during rough markets. The next thing is time horizon. So people often say the younger you are, the more risk you can take. And maybe that's true, but and the thought process is that if something goes wrong and you lose money, you have more time to make up for it. But maybe you could also say the younger you are, the less risk you need to take to achieve your goals, right? If you're young and you have a long time until you plan to retire, maybe you could just invest in solid, medium risk investments and simply let them compound over time. You might end up in just as good of a position with a much smoother ride along the way. It all goes back again to what your goals are. If you never have done this before, look up compound interest calculator. I'll leave a link to one in the description as well. But I wanted to share two scenarios. So this one, you have an initial deposit of $5,000 and 8 years of it for 8 years for it to grow. A rate of return of 12%. So maybe this is something considered a little more risky, more risk, but more reward, right? And then you're contributing $100 monthly. So you get up to almost $30,000, right? Not bad. In this example, say you have the same $5,000, but you have 15 years for it to grow, and you expect only 4% of a rate of return. That's a big difference, right? So maybe this is something much lower risk. And then you again contribute the same amount. You still end up with more than $30,000. Now, this isn't a perfect example, right? You have the contributions over time. You contribute a lot more, so it's higher. So it's not a perfect example, but it just the goal is just to show how time really makes a big difference. How time can be very, very powerful, and how you might not need to chase high rates of return depending on what your time horizon is, right? So before you start investing, I think it's important to look at all three of these things together: your goal, your risk tolerance, and your time horizon. Because the better you understand the problem you're trying to solve, the clearer your investing decisions become. So whatever you do, I think that getting started is a great thing. You don't need to be perfect on day one. Nobody is. But I think it helps to be a little bit thoughtful, especially as you get started. And if you take time to think through these questions before investing, you give yourself a much better chance of sticking with your plan long term. And sticking with it long term is what really matters. So thanks for watching. Have a great day. I'll catch you later.